War in the Middle East doesn't just affect the countries involved, it can ripple through the entire global economy. Airlines cancel thousands of flights, oil prices surge, stock markets react instantly, and travelers around the world suddenly face higher costs and uncertainty. Right now, the conflict involving Iran is doing exactly that. To understand why, we need to look at three key systems the world depends on: energy, aviation, and global financial markets. Why this conflict matters to the global economy. The Middle East plays a critical role in the global economy because it sits at the center of the world's energy supply and aviation routes. One of the most important choke points is the Strait of Hormuz, a narrow shipping route that carries about 20% of the world's oil and natural gas shipments. When military conflict threatens this region, energy markets react immediately. In recent days, oil prices surged above $90 per barrel, reflecting fears that supply could be disrupted. And when oil prices rise, the effects spread across nearly every industry. But one sector feels it first: travel. The immediate impact on travel. The global travel industry depends heavily on airspace access and fuel stability. When conflict escalates in the Middle East, airlines often avoid flying through the region entirely. In fact, thousands of flights were canceled globally after the conflict escalated, leaving passengers stranded and disrupting travel routes worldwide. Some major aviation hubs in the Gulf, such as Dubai, Doha, and Abu Dhabi, are among the busiest international transit centers in the world, handling hundreds of thousands of passengers daily. When these hubs experience disruption, it can affect travel between Europe and Asia, North America and Asia, Africa and Europe. In other words, a regional conflict can suddenly create global travel chaos. Rising fuel costs. Fuel is the second largest cost for airlines, behind labor. So when oil prices spike, airline profit margins shrink almost immediately. Recent reports show oil prices jumping significantly due to fears of disrupted supply in the Gulf region. For airlines, this creates three choices: raise ticket prices, reduce flights, absorb the cost, and lose profitability. Most airlines end up doing a combination of all three, and eventually, travelers feel the impact through higher airfare and fewer route options. Section 4: Tourism and Hospitality Effects. The travel disruption doesn't stop with airlines. Tourism in the Middle East could drop 11% to 27% in 2026, depending on how long the conflict lasts. That could mean tens of millions fewer international visitors and tens of billions of dollars in lost tourism spending. Hotels, cruise lines, and travel companies are already feeling pressure. Even destinations outside the Middle East may see changes as travelers choose different routes or postpone trips altogether. Historically, periods of geopolitical instability often lead to short-term declines in travel demand. The impact on financial markets. Financial markets tend to react quickly to geopolitical shocks. When the conflict escalated, stocks tied to travel, including airlines, hotels, and cruise companies, fell as investors anticipated higher costs and weaker demand. Meanwhile, energy companies often benefit from rising oil prices. This creates a shift in the market. Energy stocks rise, travel stocks fall, markets become more volatile. Investors also tend to move money into so-called safe haven assets, such as gold and government bonds during times of geopolitical risk. Section 6: The bigger economic risk. The biggest long-term concern isn't just travel disruption, it's inflation. Higher oil prices increase the cost of transportation, manufacturing, shipping consumer goods that can push inflation higher globally and potentially slow economic growth. Analysts warn that prolonged disruption to energy supply routes could have ripple effects across global markets and trade. Conclusion: the war involving Iran highlights how interconnected the modern global economy really is. A conflict in one region can quickly affect airline routes, tourism, demand, oil prices, stock markets, and even everyday consumer costs. For travelers, it may mean higher prices and longer routes. For investors, it means volatility. And for the global economy, it's a reminder that geopolitics can still move markets in powerful ways.